Hey everyone, welcome back to the channel. Today we're diving into two key topics that affect your finances: inflation and interest rates. These might sound complicated, but I'm here to simplify things and show you how they impact your money. Let's get into it. What is inflation? Inflation is the rate at which the general level of prices for goods and services rises, leading to a decrease in the purchasing power of money. In simple terms, as inflation increases, each dollar you have buys less than it did before. For example, if inflation is at 3%, an item that costs $100 this year will cost $103 next year. There are several factors that can cause inflation. One is demand pull inflation, which happens when demand for goods and services exceeds supply, pushing prices up. Another is cost push inflation, where the cost of production increases, like higher raw material prices, and businesses pass those costs on to consumers through higher prices. Inflation is a natural part of economies, but if it rises too quickly or uncontrollably, it can lead to economic problems such as reduced consumer spending or instability in financial markets. Central banks often try to manage inflation to keep it at a stable, healthy rate. Why does inflation happen? Inflation happens for several reasons, but it usually boils down to the balance between supply and demand in the economy. One common cause is demand pull inflation, which occurs when the demand for goods and services exceeds their supply. When more people want to buy something than there is available, prices rise to balance the demand. Another cause is cost push inflation, which happens when the cost of production rises. If businesses face higher costs for raw materials, labor, or energy, they often raise their prices to maintain profit margins. This pushes overall prices up across the economy. Additionally, inflation can be influenced by monetary policy. If a central bank prints more money or lowers interest rates too much, there's more money circulating in the economy, which can drive up demand and lead to inflation. Finally, inflation can also be influenced by external factors like rising global commodity prices or supply chain disruptions. What are interest rates? Interest rates are the cost of borrowing money or the return on investment for saving money. When you borrow money, like for a loan or mortgage, the interest rate is the percentage you pay to the lender on top of the original amount you borrowed. On the flip side, when you save money in a bank account, the interest rate is the amount the bank pays you for keeping your money with them. Central banks, like the Federal Reserve, set benchmark interest rates, which influence borrowing costs, savings rates, and overall economic activity. Higher rates discourage borrowing, lower rates encourage it. How inflation and interest rates are connected. Inflation and interest rates are closely linked because both influence the economy's overall spending and borrowing behaviors. When inflation rises, it means prices for goods and services are increasing, which erodes the purchasing power of money. To control inflation, central banks, like the Federal Reserve, may raise interest rates. Higher interest rates make borrowing more expensive, which discourages spending and investment. This reduction in demand helps cool down inflation. Conversely, when inflation is low or the economy is sluggish, central banks may lower interest rates to encourage borrowing and spending. This helps stimulate the economy by making it cheaper for consumers and businesses to borrow money, which can increase demand and potentially boost prices. So in short, central banks adjust interest rates as a tool to manage inflation, balancing the need to control price increases while encouraging economic growth. The two are constantly influencing each other in a dynamic relationship. How does this affect you? Inflation and interest rates directly impact your finances in several ways. When inflation rises, the value of your money decreases, meaning you'll pay more for everyday items like food, gas, or clothing. If interest rates are high, borrowing money becomes more expensive, which could increase your loan payments like for a mortgage or car loan. On the other hand, if interest rates are low, it may be cheaper to borrow, but inflation could still erode the value of your savings over time. To protect yourself, you may need to invest in assets that outpace inflation, like stocks or real estate, and be mindful of how interest rates affect your loans and savings. How to protect yourself from inflation. To protect yourself from inflation, start by investing in assets that tend to outpace inflation, like stocks, real estate, or commodities such as gold. These investments have historically provided higher returns than cash savings, which lose value over time due to inflation. Consider diversifying your portfolio to reduce risk. Another option is Treasury inflation protected securities, TIPS, which are government bonds designed to keep up with inflation. Additionally, maintaining a budget and reducing discretionary spending can help you manage the impact of rising prices. Lastly, if you have debt, paying it off faster during low interest periods can save you money in the long run, as higher interest rates can make future borrowing more expensive. That's it for today. I hope this helped you understand how inflation and interest rates can impact your finances and how you can protect yourself. If you found this video useful, don't forget to like, subscribe, and hit the bell icon so you never miss an update. Drop any questions or thoughts in the comments below. I'd love to hear from you. Thanks for watching, and I'll see you in the next video.